IOCL, IRCTC, and TVS. Now, brokerages largely believe that this can impact RBL's potential credit card market share in the medium term. The ROA may improve, but this is net negative for the medium-term earnings growth, is what Morgan Stanley says. Investec has also cut the target price to about 170. They believe the headline credit growth could also moderate by about 200 basis points. Citi also says that the earnings impact will be determined by how quickly RBL Bank is able to transition this lost partnership business to direct sourcing and to its new partnerships scaling up.
All right, Ritu, thank you very much for that. Thank you. So that is RBL. It's, I think, done about, 4-5% or so. Just a couple of seconds to go for the market open. We'll look at indices as always, and then we'll get down to individual stocks, etc. You got, it's a slightly positive start, so flattish start, 24,140, neither here nor there. Nifty Bank is blinking, in an undecided way. Nothing, 52,000 flat in the Nifty Bank. Sensex is down about 0.1%. And the mid-cap index is also holding on to some green, and now it's in the red. But nothing on it, nothing to show for it. Maybe a little bit more now. Nifty down about 80. So let's see, 24,050 is where the Nifty is coming up at. You got more red than green as far as the Nifty heat map goes. And we are at, I think, 30-odd names lower. Some unchanged, still opening up, and the rest which are higher. So it's got shades of more red than green at this point in time. Nifty Bank is down about 0.4%. That's a 200-point cut now. So it's a little more, lower to begin the day with. So that acknowledgement maybe of that weaker GDP numbers coming through, it would be kind of weird, right? If the market opens up 100 points with a 5-handle GDP number. So you got that acknowledgement coming through. But as we've been saying, it's not as if the market did not know that growth is slowing. Corporate earnings foretold the slowing number, although not to take away from the shock value of that 5-handle number, 24,050 on the Nifty.
The shock value, and also, Prashant, inflation, right? The market also knows that when inflation is running above 6%, can the RBI really suddenly go out and do a bazooka? Maybe not. And that reality, this twin problem of slowing growth and very sticky inflation, this is really weighing on the market's mind. Let's see, 70 points down on the Nifty. So what's weak? Almost everything, barring auto, by the way. Britannia lower by about 1.5%. Some of the life insurance stocks are still falling. HDFC Life, for instance, is down 1%. Lever is lower. ONGC, L&T, Infosys, TCS, Titan. You can see it's cutting across sectoral lines. It's not one sector that's taking the market down. The Bank Nifty is down in sync, in step with the Nifty, a cut of about 0.3% there as well. Reliance, ICICI Bank, SBI, Bajaj Finserv. Actually, let's see what's happening to Bajaj Finance as well. Bajaj Finance is down about 0.5%. So everything down, barring, like I said, autos. Let's pull some of those names higher. Bajaj Auto, Tata Motors. Maruti flashed a bit of red, but I think it's already slipping. So yeah, let's see if this lasts. Shriram Finance is doing very well. 1.5% up on Shriram Finance. Okay, so is the market thinking that maybe there'll be more tie-ups coming Shriram Finance's way? I'm not sure. Maybe that's a simplistic argument. But anyway, for what it's worth, it's the best performing stock on the Nifty. There's Sun Pharma that's continuing its good form from last week as well. So that's about it. 82 points down. It's a weak start.
Well, some further gains coming in for Aster DM. The street likes what the management had to say, that EBITDA number is going to move up by 10 to around 15% in the next 24 months. So that's why it's building on to gains, up 4%. From the Adani Group stocks, Adani Green, that's firing away, up close to around 7% on large volumes. So that's one of the top volume movers in today's trading session. From the frontline names, the Nifty is down close to around 80 points, but you have Adani Ports that opened up mildly in the green. There was that visit that Nuvama had done as well to their site, and that stock, in fact, had opened up with some green. Now it's up only around 0.5%. EV plays are in focus. Greaves Cotton, finally, that value unlocking is likely to take place. That's what they've disclosed to the exchanges. Market share has been a little bit jittery. I don't think they have a PLI as well in there, and there's a mad scramble with regard to the EV market share. But for the time being, the stock is still holding in the green, up close to around 3%. I'll be interested to see whether or not the street holds on to those gains, because the environment clearly is challenging, as we have seen from Ola Electric. Last week, it saw a big run, but market share is slipping for them as well. So that's why the stock has cooled off. One of the top volume losers on the downside, Ola Electric comes up for you. The other couple of stocks, Home First Finance, at large trade, I think, has just taken place. And the low of the day is something that I'll be monitoring. I think it is at around 985 approximately. So keep an eye out on that one. I think that large trade has taken place. Aeroflex, that's one of the stocks that is up in the green, up close to around 5% as we speak. So keep an eye out on that one. And in terms of order wins, KEC and Kochi Shipyard, both of them higher on order wins is what you have seen, while KPI got some forward movement with regard to one of those orders. So I think we should get that one as well up for you on the screen. Prashant.
All right, almost a 100-point cut on the Nifty, 24,033. More stocks coming up in a bit. We've got Karthik Kumar now joining us, fund manager at Axis Mutual Fund. Karthik, good to have you with us here as always. Thank you for your time. You got this 5-handle GDP number now in the mix. Does it change? How does it play for investors, for people managing money in terms of how you're approaching things? Complicates the situation, or you think it's kind of fully sort of factored in? And in any case, expectation was that Q3 and Q4, both on the monetary side and the fiscal side, things will ease up a little bit. Go on.
Thanks for having me. As you said, it probably complicates a bit. But having said that, we had expected softer numbers given the slowdown in high-frequency indicators and also the fact that the earnings season wasn't as expected. So a lot of it was kind of expected, but the extent of the disappointment probably wasn't. But having said that, if you look at the markets from an earnings perspective, we've gone from an expected earnings for FY25 at 14%, and that has now come down to anywhere between 9 to 11%, depending on the universe you're looking at and the house you're looking at. So I think the earnings cut has already taken a large part into account. As you said, a significant portion of the slowdown happened because of slower government spending and slower credit offtake, which both one could argue that the government has levers going into the second half of the year. So that remains to be something that we need to watch out for.
Karthik, hi. So just give us the overall portfolio construct. It's a complex market that we're navigating, right? I mean, FIs are still selling. The correction, I don't think, is entirely over. Incremental local data has started slowing down. So just tell us the market construct right now. What are you long on? What are you avoiding? Just an overall view.
So as you rightly pointed out, FI is still selling, but the pace of selling has gone down significantly between October and November. And having said that, while the markets have corrected, but if you kind of scratch the surface, what you notice is that small caps and mid caps have kind of held off much better or much well in this correction. Plus, if you look at it from a sectoral basis, so something like a real estate, PSU banks, these sectors that typically you think would underperform in these kind of environments have continued to do well, whereas your traditional defensive kind of sectors or sectors that we traditionally associated to do well with market corrections have kind of lagged during this period. So the market correction doesn't, if you look at the market surface breadth, it doesn't suggest that the market is panicking by any means. From a style perspective, again, you see over the last month, it's actually the slightly higher volatility stocks that have done better than lower volatility stocks. Higher beta stocks have done well last month, and even from a style perspective, momentum has kind of done reasonably well over the month, despite volatile November as well. So, and it's done well through the year as well. So those are the things that kind of suggest that while we are seeing market correction, this is more par for the course, and at least it's not panicking based on the market breadth. Areas where I am bullish on through our quant fund essentially is we are overweight. It is more stock specific rather than sectors in most cases, but we are overweight telecom, discretionary stocks. Again, when I talk about consumer discretionary, it is kind of diversified across subsectors and more stock specific. And then pharma, I would argue, is one area that is more sector specific, where there are stocks across sectors that look well. On the underweight side, continue to be underweight private banks. I continue to be underweight commodities in general. Those are the main areas of overweight and underweight.
All right. Hi, Karthik. Good morning and good to see you. Well, at that call on private banks, I recall you've been underweight for some time. And I think at least for now it's worked out. And these FI selling, they'll be selling where they hold the largest amount of stock. And that's actually some of these banking names. But let's delve a little bit into sectors you're overweight on. If you said it's going to be stock specific. But if you could help us out, Telecom case in point, are you all playing the core telecom company? If you could give us some idea on that. And dwell a little bit more into consumer discretionary. What do you like out there?
So as you kind of hinted at it, telecom, we are playing through the core telecom companies. In discretionary, it is a good mix of two-wheelers, gold, some gold link plays, gold link companies, and lastly, fast fashion companies as well. That's where we have exposure to on the telecom side. As you touched on within financials, you can bucket stocks within the financial category into different subcategories. And I think capital market plays still look kind of quite interesting versus some of the private banks. Having said that, I'm selectively overweight private bank, but largely private bank as a group still continue to remain underweight. No, largely because there is opportunities elsewhere in that space.
Okay. By the way, just pointing out, the market is down 100 points. So there's no early recovery of sorts. It's still a bit of a slippery slope. Mid-cap index holding in positive territory.
Absolutely. Lots of stuff moving around though, and market breadth is catching up, and that's a good thing. It was steep, it was sharply lower, so 800 stocks were higher and about 1,200, 1,300 stocks were up. And now you got about 1,000 plus stocks in the green and about 1,250 in the red. The divergence is not that sort of large in that sense. As we look at things, Sagility is one name which started lower. It is starting to already sort of pick up once again, and some of this stuff, of course, has done very well recently. AG's Logistics, for example, that is seeing a sharp 7% odd cut coming through. But again, it's had a decent run from the lows recently. And if you look at the Adani Group stocks, it's a kind of mixed picture. Ports is higher. But you look at Adani Energy Solutions, names like Adani Total, they are down, but just some profit booking. But because from the lows, they've also come up quite nicely at this point in time. 115 points lower is what you have on the Nifty. Surbhi.
I just was wondering if we picked out Dixon or not. Dixon is surging on good volumes as well because of the fact that they're making the Pixel phone now. It's another marquee sort of logo getting added on in that respect. Anyway, we spoke with the company last week. Their targets are very, very smart in terms of growth and margins. All the businesses are firing across the cylinders, so to speak. Okay, Karthik, so just to go back, you've made the point on the underweight call on financials and consumer discretionary. You said that you like some of the gold financiers. Anything else? Because on consumer discretionary as well, there's been a lot of debate about whether there is this urban slowdown, though I know the Black Friday sales apparently have been a huge raging success, but that's thanks to the discounts.
So slight correction there. I like the gold plays within the consumer space. So-called more like gold retailers, not necessarily financiers. That's on the consumer side. And as I said, very selective across consumer space in general, because while there are positive data points like you mentioned there, but in general, we are seeing the growth being revised downwards, and if anything, earnings downgrades being more focused on certain areas, especially in consumer, both discretionary and the FMCG space. So we are a bit cautious out there.
All right. We'll leave it on that note for this morning then. Karthik, thanks very much. Good to have your perspective in. Guys, by the way, I don't know if you all bought anything for Black Friday or not. Apparently, it's become very, very big this time around. Prashant? No, nothing? Okay. Anyway, let's go back. Speaking of consumption and growth in the economy, it's good to go back to the biggest story of the morning, which is this big GDP shocker that we got in the second quarter. 7-quarter low in terms of GDP growth. So what's the street making of it? Hormuz is here with the street view. Hormuz?
The consensus at the street is that every single brokerage has cut its FY25 estimates for the India's GDP growth going forward. And we'll start off with a few of them. And JP Morgan is the first one. And now there is a clamor that is growing in for a rate cut as well. But JP Morgan believes that they may see some liquidity measures coming in from the Reserve Bank of India. But the first rate cut that they expect is only in the month of February next year, although that the odds of the rate cuts have risen going forward. Now, Citi also believes that they have revised their FY25 GDP growth from 6.4% from 7% earlier. Although they say that this elevated inflation, it makes a December rate cut unlikely, but they may see some liquidity measures like a CRR cut coming in from the RBI next week. And also you could see some renowned urgency coming in when it comes to public capex measures going forward. Now, Goldman Sachs has also lowered its CY24 and FY25 GDP growth forecast respectively to 6.4% 5% and 6% going forward. And they also said that they are maintaining their CY25 and FY26 GDP forecast at 6.3% each. Now, Jefferies also believes that this slowdown in government spending and bank credit growth, both of them are phenomena that could see a reversal in the second half of FY25, and as a result, they are the possibility of a CRR cut from the RBI in the next meeting, which is next week, which is later this week, goes higher as well. And Morgan Stanley also expects the rates to remain unchanged this week, but the RBI may announce some liquidity measures, saying that an OMO or an open market operation might be announced going forward. So the rate cut, there is still a divergence when it comes to rate cut expectations, but some liquidity measures can definitely be announced by the RBI this week.
Okay, all right. Thanks a lot for that, Hormuz. Well, let's focus on the first management that we're getting post-market open. That's NLC India. The stock has been an underperformer this year. Single-digit returns is what you've seen. The company has a big capex that they plan more than 1 lakh crores. And also, we want to get an idea about how business momentum is shaping up. To help us out with that, we're joined by Mr. Prasanna Kumar Moddupalli, the Chairman and Managing Director at NLC India. Hi, sir. Good morning, and thanks a lot for joining in. Good to see you, and as always. Well, let's talk about the renewable energy part of the business. You know, that's something that we quizzed you the last time around as well. And we will ask you, when exactly should we be seeing that IPO? What's the updated on the renewable energy part of the business? Could you give us some guidance about how that's scaling up? An IPO when last quarter of this fiscal or first quarter of next fiscal?
As you know, as on date, we are operating 1.4 gigawatt of renewable capacity, around 50 megawatt wind, and balance is solar, particularly in the state of Tamil Nadu. We are targeting to take this 1.4 gigawatt to 10 gigawatt by 2030, almost a 7-fold increase in the renewable capacity. So in this direction, all the activities are already in progress. We are going with the 300 megawatt project in our Barsingsar project in Rajasthan, and 600 megawatt in Khavda solar park, and 800 megawatt also in Rajasthan. And we entered a JV agreement with Rajasthan government for 2 gigawatt renewable capacity addition. So for reaching to 10 gigawatt capacity, we are already having plans. As you rightly said, we are targeting to monetize our existing renewable assets, 1.4 gigawatt. For that, we formed one renewable 100% owned subsidiary, that is NLC India Renewable Energy Limited. Now we are in the process of transferring the existing assets to NIRL, that is NLC India Renewable Energy Limited. And recently, we achieved a major milestone in that process. We received capital gain exemption from Ministry of Finance, Government of India, which is a major milestone for transfer of the assets. So once the assets are transferred, I think by the third quarter of the next financial year, the actual process of the IPO will come.
All right. So, Mr. Moddupalli, you're telling us that now that IPO, renewable energy IPO, should be something that we should look forward to in the second half of next fiscal year. You know, earlier this week was hoping to hear about it in the first half. But now you're saying, give and take everything, you're expanding capacity, and realistically, we should look forward to it only towards the end of FY26. Is that correct?
Exactly.
Okay.
All right, Mr. Moddupalli, hi, good morning. Good to have you on the show. I just want to understand what's happening with respect to lignite mining at NLC itself. I think there were some land acquisition issues. There was some arbitration going on. But is that all of it resolved? And by when can we expect the contribution to start happening?
Madam, the last year, H1, there was a substantial loss of generation on account of lignite non-availability. As you rightly said, there were some issues of land, and there was some diversion of river was pending. So we, in the first half of the last financial year, we completed the diversion of the river, the Parmanar River, as well as substantial portion of lands were taken into possession. So from January 2024, our lignite production is to peak capacity, and we are not losing any generation on account of coal. In fact, in the last financial year, we achieved all-time highest ever coal plus lignite production. So as on date, all our mines are operating at full capacity, and the major land acquisition issues are sorted out. We are having sufficient land to carry out the mining activities going forward.
Fair enough. So can you just give us an update? How much do you think the lignite business can contribute to the overall revenue for this year? What are the projections? And that will bring us to the overall expectations as well. I mean, if you could just then tell us about the regulated equity, the outlook for this year and the next year.
Well, our lignite production last year was around 23 million metric ton. This year we are targeting more than 25 million metric ton. Coming to the contribution, most of our lignite production we use for power generation because it is a pithead stations are available. So our contribution, our whatever revenue comes, that comes from the thermal power generation, not exactly from the lignite production.
So regulated equity, sir, FY 25 and 26, what are the targets?
FY 25-26, I'm talking about 25 million metric ton of lignite.
Got it. Now, sir, what we're referring to is regulated equity. I think as of now, it is approximately 8,000 crores. Is that correct? And I think you have a plan to take it to around 23,000 crores by 2030. So can you tell us if that is on track? I think in the next 1 year or so, from around 8,000, it's expected to go up to around 11,000. Just want to reconfirm about this regulated equity and the way it's going to move up.
Exactly. Well, what you're telling is correct. It is our regulated is around 7,000 odd. And as our Ghatampur thermal power station is COD of unit number 1 is about to happen, and other units also will be completed earliest, then we will be reaching to regulated equity 7,000 crores. And after we add the capacity at Talabira and Neyveli new expansion of 2 into 500 megawatt, finally by 2030, the regulated equity will become 23,000 crores. And by 2030, we are targeting for 10 gigawatt of thermal capacity and 10 gigawatt of renewable capacity. So the regulated equity will be 23,000 crores, and almost that much will be in non-regulated equity also.
All right, we leave it there, sir. Thank you very much for joining us and running us through all of that detail. Good luck to you and your team as you continue to execute. Look at the market, by the way. The Nifty is recovered and sharply so from the lows. We are down just about 40 points. That we basically come up quite nicely. And the advanced decline ratio, it's now flipped. So 1,300 stocks are higher, and you got about just under 1,100 stocks which are lower. There you go. That's what's happened in the last couple of minutes that we've been in conversation with the NLC management. Just to look at stocks here, I think CAMS is a new addition in the mix in terms of what's doing well. CAMS is up about 4%, 5,120 or so on CAMS. Cochin Shipbuilders, I think 5% higher, 1656 or so. Torrent Power was not there in the mix in the morning when we started. It's about 5% in the green. There's Hikal, which is up 5%. Viatech Vabag is a new addition, at least in terms of the volume-led gainers list. It's up about 4%, Viatech Vabag. Himmat Singh Ka Seed, the textile apparel maker, 4%, 187 on the stock. More names. NRB Bearings is up about 6%, and it's got decent-sized volumes for this point in the day, 300 plus on that one. EPAC Durables is up 5%. But yeah, I mean, the volumes then are still picking up on what is higher at this point. But there is a solid recovery which seems to have set in, although this is still the first, 30-odd minutes of trade that we are tracking. On the downside, I mean, Afcons is down about 2.5%. It's a recent listing. BKG, I think we highlighted. GE Shipping, I saw in the morning as well, down about 2.5%. So it was down from the morning. And of course, I mean, Home First, Ola, RBL, etc. are stocks which are down. I mean, those are three biggest volume-led declines that we have, between 4 and 5% at this point in time. Surabhi.
Okay, I think that's the market recovering. Let's see if the bulls can prevail. We'll take a quick break on that note. We'll come back on the other side and we get chatting with yet another company. The management of Sheela Foam is going to be joining in. We'll not only get an update on the Q2 performance, but more importantly on the outlook ahead. Is the consumer really slowing down, or is it not that bad? We'll ask Rahul Gautam of Sheela Foam. Welcome back. The next management on our radar is the management at Sheela Foam. Now, the stock has been under a little bit of pressure of late. It has corrected about 35% from the 52-week high, but then the market has been correcting overall. So let's keep that in mind as well. What is the outlook for the second half? How is demand shaping up? And of course, how is the integration coming along with Kurlon? Lots of questions there with the management. So we've got Rahul Gautam, CMD of the company, joining in. Mr. Gautam, great to have you on. Thanks for being with us. So if I look at the the performance revenue second quarter, I'm just reiterating numbers for the benefit of our viewers. Your revenue was up 33%. The margin was lower because there were a couple of one-off items. But you tell us, I mean, before we talk about specific Kurlon integration, in general, how is demand on ground? Considering we are hearing a lot of this chatter about urban consumption slowdown, what are you seeing?
Thank you. Thank you very much for inviting me. So I think that I don't quite agree with you in the sense that from October onwards, when the season has, or the high season has begun, demand has been consistent and it's on the rise. Of course, we are governed not only by this season, but we are also governed by the wedding period. And this time is an extended wedding period which goes on up to the third week of December. So that may be a silver lining, but otherwise demand is consistent and high.
Okay, that's very good to hear, sir, because we do try and get this dipstick survey going with all consumer-related companies who join in. So you're saying you're not seeing slowdown, and plus this is the wedding season, so things should look good. So give us a sense, I mean, on a full-year basis, and now that sort of Kurlon is in your fold as well, on a full-year basis, what's the growth you're expecting this year? In a steady-state basis, the whole combined might of the big brands, what is steady-state revenue growth, say, for next year as well?
So I would say in the second half of the year, we should register anything between 13 to 15% growth. And we have to remember that Kurlon was added to the group only October last year. It was actually middle of October last year. So really the comparison and the impact of the integration and all that has been happening only in the second half. So we expect that by 31st March 2024, 2025, we should really be ending with 14-15% increase in the revenue.
So that's total FY25 total revenue is up about 14-15%, Mr. Gautam? Is that what you're saying?
I would say that would be close to about 10%, but the H2 revenue would be up by 14-15%.
And then since we are all the way to about March of 25, would you want to hazard an estimate for the year after that, 26, when all of this would be completely integrated? I mean, what would the ambition be, an overall company basis for 26?
So I think two impacts would be there. One would be our integration getting completed, and the second would, of course, be the environment part. As far as the environment part is concerned, I would not hazard a guess on that. Though it looks robust, there are no reasons why it should fall down or dip. But I think the real impact would be the integration part, which I would say is about 75 to 80% complete. there are a few things in the front end which needs to be sorted out, and we are on track for doing it. And as I said, it's been about a year that the acquisition took place, and as we all know, the integration is always a bigger thing than the acquisition part.
So for full year 26, would you want to go with a number? I mean, at least ambition-wise.
Ambition-wise, 15%.
15% growth. All right. Hi, Mr. Gautam. Good morning and good to see you after a while. This is Nigel on this side. I wanted three basic numbers with regard to Kurlon. You know, you're sounding quite optimistic that the synergy benefits are playing out according to the plan. I recall when you joined us, you were talking about margins of around 13% on this particular entity, revenue scaling to around 1,000 crores, and I think the combined market share would be around 29%. Could you tell us if that is on course?
So Nigel, on the market share bit, I would say that it's always very difficult. You know, it's how you define the market. So if you define the organized and the unorganized together, it is not 30%, but far lower, because the unorganized sector is reasonably large. However, let's look at the organized one, and you're quite right that they would be 30%. On Kurlon, I think your statement about 1,000 crores and margins of 12-13% is absolutely spot on. You know, that's what we should have.
So by when do we get to that number, that 1,000 crore revenue run rate?
The 1,000 crore run rate we would get into Q4 for sure, and even the year should end up close to that, because we've been ramping up reasonably well. But the run rate would be there in Q4.
And okay, from Q4 onwards, you'll already be on course with regard to this 1,000 crore run rate. You know, Ms. Gautam, when we get you in, we also get an insight into the raw material costs. So could you help us out with polypropylene as well as with TDI prices? What are they currently? How do they compare with what we have seen on an average in the first half of the year? And how do you see both these two trending going ahead?
So both TDI is hovering between about 150 and 160 rupees, and polyol about close to 105, 110, just oscillating in that range. Both have been rather low and steady compared to the last quarter. And going forward, I would say that this is the picture that should remain, because any indication that I get from the bigger markets like the European Union or the US, the rates are only going down. But I think we are at a low level. Therefore, I don't expect it to go down too much, but to be steady and holding at this price or in this range.
Okay. Just a word going back to the integration with Kurlon and the synergies. I mean, combined now, what is the market share, you'd be at? I think the estimates are probably around, correct me if I'm wrong, in the late 20s, right? And is there scope for market share expansion? And also, sir, a word on pricing, because you're saying the actual demand on ground is not bad at all. It's a big wedding season that we're in the midst of. So give us a sense on market share and whether pricing, whether the growth is going to be pricing led or only purely volume.
No, it's not going to be pricing led. It's not going to be. Okay. Of course, there will be some small little changes of 2, 3, 4% but that's not going to impact the top line so much. And the market share, we are.
Yes.
Let's say we are 30% of the organized market, and we expect that share to go up as we move forward.
All right, very quickly, before we let you go, the two talking points are, is the Indian economy slowing down, and what is Trump's impact going to have on the United States? I recall when we chatted once, you said that the US could be closer to 100 crores of revenue run rate. Is that on course, and by when do we see that?
Sorry, I didn't follow that.
The US revenue run rate, I think you were hinting that it could be 100 crore potential. Could you tell us?
Yeah.
Yes.
So I think that potential absolutely exists. It completely depends on the duties that have been levied, and US has been extremely erratic on levying these anti-dumping duties from various sources. India is aptly placed for supplying, But at the moment, the anti-dumping duty is of the order of some 35-40%. That's just too much for export to bear. We expect that to change as Trump comes in. He would be, but he's still a very loose cannon. I wouldn't hazard a guess, but with whatever relationships that exist between the country and his little bit of a bent towards India, we should expect this anti-dumping duties to kind of come down. Like today morning's newspaper, I just read that that he intends to put 100% tax on imports from China. Now, let him come in. But our duties should only reduce, which means it should improve our chance. Whether it makes it to the, just over the line to be in a position to export, we'll just wait and see that.
We'll have to wait and watch. As you said it,
Yes.
tongue-in-cheek, loose cannons. We don't know what to expect next, but you're saying the potential of 100 crores at least is there. Always a pleasure
Yes.
talking to you, Mr. Gautam. Thanks a lot
Thank
for
you.
joining in and wishing us, and helping us out with all of those details. In fact, as we had your commentary coming in, your stock price as well has recovered from the low point of the day. So it seems the street is taking heart from all those statements that you just gave us. Let's turn our attention then from mattresses to the cement space. Mr. Anil Singhvi, the executive chairman at Sri Digvijay Cement, joins us to tell us about how the industry is shaping up and also give us a sense about the company that he's heading. Hi, Mr. Singhvi. Always good having you on the show. Thanks a lot for joining in. Let's talk about industry first. Are there signs that the cement industry is set for better times? There have been, patches of exuberance that have been displayed. But now do you think demand will continue to remain strong from here? Point number one. Point number two is pricing has been a disappointment. Have prices bottomed out?
Thank you for having me. My views are very simple. I don't think still we are seeing a good, robust demand in cement, which should have been there. I think we blamed earlier summer being hot, then we blame monsoon being wet, and now perhaps we will blame the winter being cold. I think the seasonality, sometimes plays a role, but I think today we clearly see that there is not much of capital expenditure by government. So government spending is at a observably low, and private investments are not taking place. So I think cement is one industry I can speak for. I think we are still seeing a very struggling time. And let me dwell on the subject of cement demand. I think one has to look at the growth in cement, which includes the pricing as well. So I'll address your question in twofold. One is the demand per se. I think this year, 24-25, I will be pleasantly surprised if we have 3 to 4% growth, which also looks to me a daunting task. But when you look at the growth in cement, which includes the pricing, I think this will be perhaps one of the few years I have seen in 40 years where you're going to have a negative growth of cement.
Okay.
Because the prices are still 10% lower. So
All
when
right.
looking at the demand point of view, demand 3-4%, but prices lower by 10%. So negative growth in cement by 5 to 6%, which is a huge cause of concern for not only for cement industry, for GDP growth as well. In fact, I read somewhere in this morning that moneycontrol.com saying that experts are now revisiting the second half numbers. Now you can't have these so-called experts for the simple reason they got it so wrong in the first half. How do you again pin your hopes all on the second half and say that second half will be so good that it will recover for the first half? No, I think we have lost a big plot here. I think GDP growth itself should be, I'll be surprised if it crosses 6%.
Interesting, Mr. Singhvi, you're saying it as it is and how you see it, and there is hope out there. But as we know, hope is not a data point. You're giving us a data point. You're saying that the growth will be only 3 to around 4%. What about for your company? There was a bit of a degrowth that we have seen in the first half of the year, and the EBITDA per ton as well has come down. What should we be working with for the second half of the year? On your side, you've been using alternate power, green energy as well, and that's what's helped you all on the cost side. But if pricing is weak, then that puts pressure on the EBITDA per ton. So give us both those two numbers.
Yeah, I think we are still not seeing much of price increases, which should have come to cover up the last 7-8 months of low prices. So prices are still, a chase game. It's not reached to the level where we would have liked to see it in December, because now you're left with just about 3.5-4 months for this year. So I expect still the prices are, going to remain 5 to 7% lower than last year. which is making impact on the EBITDA margins and demand. I mean, pricing is again a factor of the demand, and demand is still playing very, very spoil sport. So I hope and pray, but I think we all seem to be living in hope. But I think something has to be done in terms of government spending. I was looking at some data that last 8 months government spending is still just about 40% of what it should have been. And unless we accelerate that process in next 2.5 months, it's going to be a lost cause. And once Indian economy has this, and I've seen it enough time. I'm not an economist, but if you have a dip coming in, then to recover takes humongous time. So if it allows economy to drop at around 6% or lower than 6%, which this quarter had given, I think it's going to be a very, very challenging thing to go to 7-8%. And we all were expecting it to be 7-8% on a sustained growth basis. I don't think just making those announcements is going to make any sense to me. And cement is a barometer. Let me tell you that cement is a good barometer to judge which way we are going. Whether it's a poor man or a high rise in Bombay, what you see, cement is consumed by every single human being. Be it repairing, be it extension, whatever it is there. Even if you make your roof, which is made of thatched situation to a cemented one, that shows the growth in economy, that shows the prosperity. So I think cement, and somewhere you see the GDP, you see the GST numbers. Cement, according to me, is the second largest contributor to the GST. And GST numbers net of refunds are not showing a very good growth here. So I think there is a bit of a. I think we need to really sit down as a country, as economists, as a government, to see why is that we are falling so badly this year.
Okay, all right. So for your company, should you end the year with flattish volumes, and EBITDA should be in that vicinity of what? Say we have some kind of improvement. So for the year, it should be in that vicinity of around 700-800 rupees.
I think we would have a marginal growth. I would still hope that next 2-3 months should be able to get us some growth. That's again hope and pray. And pricing, I mean, if we do about 700 rupees EBITDA, I think we should be lucky enough for this. This year has been one of the, according to me, this is one of the very surprising year. Let me use that word. So I'm disappointed, but very surprisingly on a negative side. Why, despite being, last 2-3 years having such a good growth, all of a sudden we have fallen from the cliff.
What about your expansion plans? You all had raised out that plan to increase cement capacity from around 1.2 around 3 million, as well as there would be some clinker addition as well. By when do we see this coming on stream?
This should be coming by March 25. So I think in about 2.5-3 months time. But again, my fingers are crossed because today we are not seeing much of a good demand coming up. So it will be quite a work to be done to sell almost double the quantity next year. So I think it's a challenging time.
All right, Mr. Singhvi, what about you? What is your stake in the company as of now? You had around 2.2%, which came down a little bit. You had some personal needs. Are you still holding stock?
Yes, of course.
But it's
it's
sub 1%, sir. So that's why we want to ask you, because a lot of viewers write to us. They are like, that Mr. Singhvi obviously has turned around the company and it's done very, very well. But does he hold stock as of now? So do you hold stock? If you could clarify that, because it's below that 1%. And for us on the BSE, we can only see a % plus. So if you could clarify.
Yes, I confirm that I own more than 1%.
So you cumulatively still own more than 1%?
Yes, as of today.
Right.
Yes.
As of today. All right. And you have no plans of selling more stake, from here on?
You asked me a question of what I hold today. I'm telling you today. I'm not an economist, not an astrologer.
Okay, all right. So 1% is what you hold. We take that. What about the promoter entity? There's a lot of consolidation that's taking place, and I've asked you this before as well. What's the PE's plans? You told us that the PE would like to hold on for a little bit longer. It's not like what it was in the past. Do they still have that sort of a mindset that they'll still wait for the capacity to come on stream and then, in fact, maybe scout for a new buyer?
As I mentioned to you in past as well, that it's been about 5 years plus. Obviously, most of the private equity firms have 5 to 7 year horizon. In this case, I mean, I can't speak for them. But looking at the current scenario on the industry, and we are looking at the expansion and all that, I think they would rather wait than to sell it today when the going is so bad in industry per se on that. So I still believe that they will see some more value coming into the stock.
Okay, all right. Final question then before we let you go, Mr. Singhvi. What about the industry? There has been a fair bit of consolidation. Pennar we never thought will happen. That happened. Kesoram has happened in the last year and a half or thereabouts. We have seen India Cements fold up as well, Orient Cement as well. Some more assets you expect to get folded up? Because for sure, I mean, you and me, we know that there are a couple of assets around the block, but are you expecting M&A action to continue in this fiscal as well? That's before March?
I think cement is one industry which is still very fragmented. So some consolidation may take place. I think it will be again depending upon the per ton capacity pricing, because when you look at the earning potential of the industry or the company which are in there today, they are under a lot of distress. So I think the activity which until about June, July looked very, very robust has slowed down for a simple reason that industry's growth, both in terms of price and in terms of volume, has tapered off very, very big way. So expectation of the buyer and the seller, I think the gap has widened since then. So I don't think it will be as accelerated as what we have seen in last 6-8 months. But you can never say no.
Okay, all right. Well, thanks a lot for joining, Mr. Singhvi. You poured some cold water actually on optimism that we were hearing earlier today. You're saying that there has to be some action on ground. As of now, that's lacking. And hopefully things will pick up both on the demand as well as on the pricing front. Always a pleasure talking to you. Appreciate you speaking to us here on CNBC TV18. Well, let's get a check on the markets. By the way, we were down close to around 100, 120 points or thereabouts, and that dip has got bought into. The Nifty has moved into the green. The mid-cap index is up close to around 100 points, and that's telling you the sentiment. You have a lot of domestic money that's at play. So maybe the FIs continue to remain sellers, which in all probability will be the large cap names. But the mid-cap index seems to be having its mojo back. That's what we've seen for the last few sessions. Mitesh is back with us. Mitesh, what's your take? If you bought the morning dip or not?
We did not, but then again, the idea was that we were positive, so we were hunting in stock side. I think I still believe that the Nifty is well poised to retest 24,350. Only thing is that let the intraday indicator fire a strong buy. Till then, I think stocks can be traded on the positive side, and I have a buy on Info Edge or Naukri. That's a buy with a stop below 83.30 so about 100-point stop loss, but just 1.25%. It's 83.30 being the stop loss. Look for targets of 86.50 to about 8700 here. And Metropolis is the other one. That's a buy. Keep a stop below levels of 21.49. Look for targets of 22.60.
Okay, all right. Mitesh, got it. Thank you very much for that. We'll touch base with you during the course of the day. Let's see how things progress. Now, I need to take a break right now. We'll come back and talk commodities. Manisha will join in on the other side. Welcome back. Well, the equity markets are flip-flopping between green and red, and it's all about the GDP number. Let's see what's happening in commodities. What's keeping the international commodity markets excited this Monday? Manisha, good morning. You tell us, what are the headlines?
Well, last month of this year, and if you look at the agriculture commodities, well, that is where I'm putting focus on right now, because we just keep talking about non-agri all the time, but agriculture is a big space. Internationally, especially, you have big monies being made into this one, and the volumes are on the higher side as well. I'll start with edible oil space, and here we've seen some bit of a decline coming in. Soybean, for one, while, of course, in the month of November did see some gains, but flat on the larger side, has seen a 24% decline. If you look at the other edible oil prices, that pretty much has been the case. But for soybean especially, well, the prices have been on a downtrend for 2 years now. We've seen rise in global supplies. It also has to do with the fact that the prices have been on a downward trajectory since May 2022. And that is the time we saw 10-year highs in case of soybean there. I also want to take you to other commodities. While wheat prices have seen a decline in this year, thank God for that, because one, you have higher supplies coming in. The global 2024-25 number for the international markets is looking higher at 79.3 million tons there. Take a look at the cotton prices, and it hasn't been a great year for cotton. One, you had higher supplies. Two, the demand wasn't so strong. The freight has been higher. It has been delayed movement of shipments as well, and all of that continued to weigh onto the markets there. And then when you talk about sugar, well, that has been another area where we've seen prices decline on a month-on-month basis, but for the year, 2.5% on the higher side. Brazil for 2024-25 is looking at a record crop, and that continues to keep the prices in check. Much of that speculative activity that we saw in the first half of the year for sugar also seems to be now getting out. And December is a month where you see a lot of books getting closed, trades getting unwinded. So that is the time that you could be looking at further declines, especially on this one. Well, that has been about losers, but these are the gainers, adding to the inflation in the market as well. So palm, for one, gained up by 7% for the month of November, 35% up. Well, palm is used in edible oils, as in sense of food, your cosmetics, your detergents, your pharmaceuticals, and we do know that the price rise has come in sense of soaps and shampoos. That is where palm also goes in. Sunflower has been on a higher side as well, 60% up in this year. We've seen rubber prices gain up by 25% as well. And if you look at the other commodities, well, coffee and cocoa should come back on your screens yet again, because the major run-up has actually come in for that. Coffee prices have gained up by 70% in this year, and cocoa is up by nearly 116% as well. Well, we have seen Brazil output continue to decline. Vietnam is another big one when it comes to coffee. There as well, we've seen output decline. Cocoa is a major crop in Ghana and Ivory Coast, and we have seen prices at an all-time highs in this year into that one as well. So while essential commodities like wheat, rice, edible oil has seen a decline, but all your exclusive commodities, a bit of a luxury commodities, all have seen strong gains.
And now we know why our cafe mocha has gotten more and more expensive over the course of this year, and it doesn't look like there's any respite around the corner, Manisha. Thank you so much for that. All right, quick check on the markets before we take our next break. It's very, very flat. I mean, at the index level, not much is moving. In terms of the stock-specific action, the mid-cap market is holding on to about a 0.5% gain now, and the advance decline ratio, that's starting to climb towards the positive side of the screen. So that's the good news. By the way, watch out for some of the life insurers. HDFC Life is down 1.5%. SBI Life is also lower, but not too much. SBI Life is more like flat. Life insurers continue to reel under pressure. That was a big story last week. Aside of this, let's look at some more names. Dixon Tech, because of this Google Pixel tie-up, that's really turning out to be one of the stocks of the morning. About 5.5% up on that one particular name. 6% now. Dixon is up about 6.5%. It's a big, big move coming through. And look at Torrent Power. So mid caps and small caps is where the action is. I'm just taking some names as example. Torrent Power 6% higher, looking fairly good at this point in time. Let's take a quick break on that note. Come back on the other side. Our special segment, Citizens Monetary Policy, is going to be starting off. Lata will be in conversation with the CNBC-TV18 Monetary Policy Committee to discuss what the RBI MPC feels could be in the offing this Friday with respect to the RBI policy.
Dr. Sen, Sonal, this time I'm taking the vote. The RBI's monetary policy has suddenly become very important and interesting, with the second quarter GDP growth disappointing hugely. The policy announcement is on Friday, December 6, and as always, the CNBC-TV18 Citizens Monetary Policy Committee meets to deliberate on the issues before the RBI and its MPC and what they may do. Let me welcome Chairman of our Citizens MPC, Dr. Pranab Sen, and members Sajid Chinoy, Shaumikanti Ghosh, Samiran Chakrabarti, and Sonal. Sonal and gentlemen, thank you very much for your time. Let me start straight away with what action is expected, because we can look at the background of growth and inflation in a bit. But first, Sajid, let me start with you. Do you think now it calls for a cut, irrespective of the fact that inflation is high?
Lata, we've always been in the camp that there'll be a cut in February. So it was not this meeting, but the next meeting. And I think what you've seen is this delicate trade-off where public investment and government spending was doing a lot of the heavy lifting in the last couple of years. And the first signs that public investment has stepped back in the first 6 months of this year, kind of softer private demand has shone through. And that we had kind of worried about and known about. The complication for the RBI is that the economy in the last 2-3 years has been hit by a series of supply shocks. Right? Food supply shocks. And so, average CPI has been 5.8% for the last 4 years. This year it's come off, it's still been 5%.
Yes.
And so that's been the difficult trade-off, that we understand the government's doing the heavy lifting. We understand private sector demand hasn't picked up where it is. But when you've got sustained repeated supply shocks and high food inflation, the worry is at some point this will spill over. Our sense is this increases the conviction that a February cut happens. I think in December, the central bank, the MPC, sets the stage for a February cut, pivots more dovishly, and more importantly, sets the stage for liquidity management. Because without the liquidity management from December onwards, any cut in February will not transmit into financial markets. So the way I see this is you use this meeting to inject liquidity, pivot, and then ease in February.
No, I think that is an important point that the Reserve Bank will think of. There is also the credibility issue, but I'll take the liquidity argument. Samiran, is there a case for a CRR cut, therefore? since, liquidity in a way is going to be challenged even in the days to come. Look at the way the dollar is strengthening and the rupee is declining.
So, Lata, if you just look at the liquidity numbers, the durable liquidity is corrected by almost 2 trillion rupees in just about a month because of mostly the FX sales and the festive season currency in demand. So, one can make a case for some liquidity easing, and not to forget that in the last 10 days or so, the market-based overnight rates are now running about 20 basis points higher than where the repo rate is. In the last few months, it has just been reverse, where it was lower than the repo rate. Now, obviously, we can decide on what instrument is the best instrument to give this liquidity. CRR is a relatively easy one, particularly if you think that pre-COVID CRR was 4%, and that's probably the only variable which has not yet gone back to the pre-COVID levels. There might be some justification for considering a CRR as well. But overall, I think at this time, I will agree with Sajid that some liquidity easing could be the first step towards a broader monetary policy easing through rates.
Okay, well, I'm going to ask the same question to actually all the members. Shaumya, to you as well. You have to rekindle animal spirits. You have to give some confidence as well. So can the Reserve Bank stay away from both a repo and a CRR? Some obvious symbolic action may be needed?
I think I take the point that some sort of a liquidity adjustment is to be done in this policy, because the simple reason is that food inflation is still running close to double digits, and headline inflation was running over 6%, and it doesn't seem to be coming off the cliff very quickly. But the point over here is that there has to be a very delicate balance of liquidity, because if you look into the liquidity management in the last couple of months, what has been happening is that the government cash balances have become the elephant in the room. From a positive number, then to WMA, then again to negative. So it has been fluctuating significantly in the last 2 to 3 months. And we need to remember that a large part of this government cash balances is basically frictional liquidity. So if there are any liquidity injections or management the Reserve Bank wants to do, it has to match that frictional liquidity with frictional liquidity injection itself instead of permanent liquidity injection.
This is what they're doing with the variable rate repo.
So from that point of view, I think while the liquidity management has to be done, but there needs to be a debate on how this needs to be balanced with an permanent liquidity injection vis-a-vis and frictional liquidity adjustment. But there is also another point is that because of this significant rupee liquidity suck out, because of the intervention to support the
dollar
rupee,
sales,
that is also adding to the problem of the central bank.
Absolutely. I mean, that's my point, So even if you look at CRR as a more permanent instrument, it looks like this dollar issue is going to be with us. So maybe there is an argument there. Sonal, what do you think?
Lada, our view is we are already late. Monetary policy works with lag of 3 to 4 quarters. The slowdown has been ongoing for 6 months now. So we think it's basically high time to reverse the cycle. If you just go back to what the monetary policy framework is, it is to target inflation 4% plus minus 2%, while keeping in mind the objective of growth. And what has become very clear is that growth is already below trend, and there is no counter-cyclical response that's coming through even now. And therefore, I think the expectations that growth will somehow go back to 6.5%, 7% without a counter-cyclical response looks extremely unlikely. I think the outlook, the entire debate, therefore, is in terms of how much trade-off there is at this stage. Now, monetary policy has to be forward-looking. The one-year forward inflation forecast is very much aligned close to the midpoint. The second round effects have not actually materialized. And the effects, some sort of a nominal adjustment on the effects is warranted as a counter-cyclical tool as well. And we have FX reserves. So I think the argument that, the trade-offs are significant because inflation is high or because currency is weak actually does not hold water. And the balance of risk, in my view, definitely calls for supporting growth at this stage because without growth, there are multiple other macro issues that we'll have to deal with. So I think it's time to support growth both via a repo rate cut as well as via a CRR cut, because even the transmission from banking system is going to take time. I mean, banks have been busy collecting high cost deposits. So even if the RBI sort of cuts the CRR now, the entire transmission to the lending rates is going to take time. So we need to act now.
No, I take your point that it takes time to act, but the counterpoint is also that why is consumption weak? Because of inflation, isn't it? Any one you speak to on the street tells you that onions still selling at 90 rupees a kilo. So, Dr. Sen, your best place to put where the policymakers hat. Can the Reserve Bank do a cut without injuring its credibility as well when the last number is above their mandate? It is 6.2, the October number.
Well, it depends on what you're talking about. I mean, if you're talking about the repo rate, I don't think there's much of a case. The really interesting question is what you do with liquidity management. There seems, one of the standard tenets of economics is that if you are getting inflationary impulses coming from areas over which monetary policy has very little control, and in this case it is food mostly, your main focus should be to prevent it from spilling over into the core. And for that, interest rate management is not the appropriate tool. It is liquidity management. Now, the question is, so I've got a situation where food inflation is nearly double digits, but I've got a GDP growth rate which is significantly below par, 5.4. And so you are getting the liquidity management demands are working on two sides. That is, if you actually open up on liquidity, you run the risk of the non-core spilling onto the core. If, on the other hand, you are too tight with liquidity, then your growth revival may not happen. And Sonal is right, we are running below trend. But I think one has to be a little careful with these growth numbers, because there is a very strong base effect which is playing out, and it will play out in the next quarter as well. It's only in the quarter after that should we expect to see any normalization happening. And we should be very careful about this. The big question out here is that when you're talking about liquidity, do you create a situation where the increase in liquidity is because the banking sector demands liquidity? Or do you create it through an instrument where the liquidity is given to the banks regardless of whether they want it or not?
Okay.
Now, that makes a lot of difference. So in a situation like this, I think the CRR cut is not a particularly good idea. One should focus a little bit more on what do we do with the variable repo.
Okay. Fair point, sir. There is going to be a lot of debate on this within the Reserve Bank MPC itself. Though CRR is not an MPC instrument, it will be a RBI decision. But in our case, our MPC is going to vote on both. Let me take the vote first. The first question I'm going to ask my panel is, what will the Reserve Bank do to interest rates on December 6th? Sajid,
we have a cut in February, so a hold in December.
Hold. Okay. Nothing, no action. Samiran? Soumya?
We are hold.
Okay, hold.
Very similar to Sajid, the hold now and cut in February.
None of you want a cut. Sonal?
25 basis point repo rate cut.
Okay, there you are. We have the first cut. And Dr. Sen? Hold. Okay, so this is 4:1 in favor of holding. Let me take the CRR question. Your thoughts, your vote.
Some liquidity management for sure, not necessarily CRR, but some liquidity management.
I'm taking a no for CRR.
But some liquidity.
Okay.
Yeah.
Soumya?
I would paraphrase it saying that CRR should be used as a counter-cyclical tool.
No or yes?
Some, not headline CRR, but yes on some specific products.
Okay. Yes, I'm going with a yes for Soumya. Shamiran?
I think it is likely, it's possible to do.
Okay, I'll take it as likely then, which is more a yes than a no. Sonal?
Yes, CRR cut.
Okay. Dr. Sen?
No.
No. Okay,
Categorical.
so categorical no. Okay, then I'll take it as 2 no's and 3 yeses. So probably more of a chance of a CRR cut. And very quickly now, last vote. When do you see the first rate cut?
February.
Soumya?
February of a larger magnitude possible.
Okay, February 50 bips. Okay, Samiran?
February.
But I think we already have Sonal's vote, right? Sonal is December. So I'm not asking you, Sonal. You can flash December. Dr. Sen?
February.
February. Okay, so just about everyone is expecting a February cut, except Sonal, who thinks that it should be advanced. But what are the arguments about growth itself? Is it as bad as 5.4? As Dr. Sen says, it is just the base effect. How do we see food inflation panning out? All those questions after the break.
Maruti Suzuki is higher in today's trading session, up almost 2% as November sales led by the SUV segment were better than expectations. Eicher Motors, however, trades lower after CV sales failed to meet estimates.
Adani Group stocks rebound continues after billionaire chairman Gautam Adani breaks his silence on the indictment by the US District Court on misrepresentation related to bribery in India, saying no one from the Adani Group has been charged with any FCPA violation and reaffirms the group's commitment to regulatory compliance.
Dixon Tech is surging in today's trading session, up nearly 6% after it begins production of Google Pixel at its Noida plant. Brokerage house Nomura issues a buy rating, sets a target price of 18,654.
RBL Bank and Bajaj Finance opened with cuts after they mutually terminate a deal to issue co-branded credit cards. Morgan Stanley and Investec issue bearish notes for RBL Bank, while Citi and Jefferies remain bullish on Bajaj Finance.
Home First Finance down over 5% after nearly 10% equity changes hands in a block deal window at nearly 990 rupees a share. Sources also tell CNBC-TV18 that promoters were looking to sell almost 15% stake in the company.
Hello and welcome to Chartbusters. I'm Nigel and with me is Mangla. Well, Mangla, before we get to the market action, wanted to congratulate you on your 10th anniversary, work anniversary. Plenty of buzz yesterday on social media as well. So wish you all the best. 10 years have been great for you and I'm sure the next 10 years will be even better.
Hopefully 10 years of, being here and a large part of that on Chartbusters as well. So a lot of love from the viewers. More importantly, we added a lot of value to the viewers together, and that's something that has always been one of our core commitments to good quality content for all of you viewers.